How is everybody doing today? Welcome back to the channel. In this video, we're going to be talking about 5 stocks that are going to be really good opportunities to buy in 2021. If they dip into a certain point, they're basically going to be easy money stocks, in my opinion, that have very good potential to grow very well within the next coming year or two, and even beyond there. So I'm going to be talking about all 5 of these stocks. They're going to be great picks in my opinion. So definitely make sure to watch until the end. Now, right before we jump into it, make sure you guys subscribe to this channel. I'm trying to hit 600 subscribers by the end of this year, and we're really close. So if you guys are watching right now and you're not subscribed, just click that subscribe button down below. That'll be really appreciated. And if you haven't already signed up for Webull, I'll have a link down in the description. All you have to do is sign up and make a brokerage and deposit $100, and you get 4 free stocks, which is already a great return on your money right there. And I personally use Webull myself. It's a great brokerage. So if you haven't already, definitely make sure to open up a Webull. I'll have it down in the description. So obviously the S&P is up huge this year, right? I mean, this is probably going to be a normal year for the S&P if the pandemic didn't happen. But with the pandemic up 16%, if not even more than that, that's pretty crazy. So a lot of these stocks have gone up way too much, right? So in 2021, a lot of people are expecting the S&P to be down a lot. Like, people are saying these stocks are even more overvalued than they were in 2001 in the huge crash we had back in 2001. So we can definitely expect some of these stocks to dip. So the first stock, let's just jump straight into it, is Corsair Gaming. Now, this stock I talked about quite a bit. In my opinion, if this stock goes below $30, it's a great buy. Now, just 5 days ago, it was sitting around $32, $33, and it still was a bit too much. But even then, if you bought it, it was all right. Obviously, it's shut up. But this stock is crazy volatile since it IPO'd just a month or two ago, a few months ago. So if this stock goes anywhere below 30, in my opinion, it's a great buy. Basically, they own Elgato, which is basically the #1 streaming product out there. If you want to stream video games, if you want to stream just anything, especially on Twitch or YouTube, like they have basically stream decks. They make green screens. They make microphones now for streaming, and streaming is a huge thing. Like, people even stream themselves gambling. Like, there's so many things that people stream themselves doing with millions and millions of active viewers. Like, more people are watching people streaming than they are TVs these days, like actual TV. So they're in Target and all that. So they're a pretty big company. They also own Scuf Gaming, which is basically the #1 controller type of basically performance controller, if that makes sense. Basically, they help individuals who are very high up, basically doing esports and or play very high in a very high level, and they basically help them with that. And it's actually really popular. Like, many people on YouTube with millions of viewers promote Scuf Gaming. So it's a pretty big company. It's been around for a while. They also own Origin PC, which is basically a pre-built PC company. The reason I think this is especially interesting is because Corsair manufactures their own stuff, right? Like, they make their own PC parts and RAM. So they actually put their own stuff in these PCs. So it almost goes full circle, right? So that's why, in my opinion, it's very interesting that they did acquire Origin PC, and they're doing quite well. Now, the reason I say it has to be under $30, because right now it's pretty expensive. They have a 4P of 26. Now, that's not bad, but I do feel like it's still a little bit much, especially if this year isn't as good for streaming and buying like digital type of goods. In terms of computers and stuff like that. If demand isn't as strong in 2021, this 4P might even be higher. So that's why I'm saying anywhere under 30. I think it's pretty much a steal for this type of company. You can see in 4 years, they've been steadily growing revenues. This year, look at quarter by quarter, they've slowly been. So for the last 4 years, all like 16 quarters, they've been gradually increasing revenues. It's almost like a thing of beauty, right? Now, the only bad thing is, and the reason why I do want it to be down that much, not anywhere in the 30s, but it has to be under 30, is because of their balance sheet. Now, the CEO is actually a very smart guy. He does have, he talks about the balance sheet once, then how he doesn't have much cash. He has a lot of debt. And the reason is because they're actually just trying to play like a very growth strategy right now. They're trying to grow as quickly as possible. And they have a lot of long-term debt that has very low interest rates right now. So they're taking advantage of like the low interest rates that's going on right now. That's basically in the record lows. And that's basically the reason why. But he does say that he's very willing to pay down the debt if need be. So I do like kind of trust on him there. So next, it's kind of an obvious one, is Amazon. Now, obviously, Amazon's always going to be growing in my opinion. It's nowhere near sight unless the government literally goes up to Amazon and makes them shut down, which I mean, I don't really think that's going to happen, but it's obviously anything's possible. But other than that, like, it's an easy grower in my opinion, easy. But if Amazon dips anywhere under 3,000, if it goes under 2,800, oh man, that's like stealing money at that point. If you're a long-term investor, that's easy money with Amazon stock. Now, the thing is, with Amazon, you're never going to get a fair valuation for Amazon. Like, no matter what happens, you're never going to get a fair valuation. Maybe in 40 years from now, when Amazon's one of those companies that aren't innovating anymore, Jeff Bezos is out of the picture, maybe, but in the next, probably in our lifetime, Amazon is never going to be fairly valued. Like, it wasn't fairly valued in 2017. It's still not going to be fairly valued today. So but like I said, anywhere under 2,800, it's stealing money. Their revenues aren't going to be slowing down. Their growth isn't going to be slowing down. They own and they're continuing to grow so rapidly. And I believe just recently they actually talked about making full self-driving cars, and they're actually developing that. Don't quote me on that, but I did hear that somewhere as well. But other than that, like, regardless, they're growing like crazy. They're trailing P's 91, but their 4P's at 58, which is obviously pretty expensive. But nonetheless, you're, like I said, you're not going to get a fair valuation, and anything under 3,000 and under 2,800. At that point, you're basically stealing money, in my opinion. Now, I don't think it's going to go down. I don't think it's going to go down under 2,000, but like, it's not going to reach anywhere below where it was this year. The pandemic has accelerated Amazon's growth. In my opinion, Amazon was always going to reach 3,200 regardless of the pandemic. But what the pandemic has done is actually accelerate that growth. So they're basically where they were maybe 1 to 2 years they would be in this price point. But because of how much everything has been accelerating, retail is going down faster than ever. That's why Amazon's ahead. Next up, let's go. The next one is Dropbox. Dropbox now is 24. Now, I made videos on this stock telling you guys to buy it, or not. I don't tell people to buy stocks, but like suggesting it, right? To look at it for yourselves. At $20, I said under $20 is a steal. I was buying it at like 19 bucks, and I'm up like almost 20%. Now, I didn't build it up into a crazy big position like I did with Tesla and stuff, but Dropbox is definitely a pretty decent position of mine, so I'm definitely happy. But nonetheless, even at $24, it's not that bad, and under 20, it's a steal in my opinion. So if Dropbox, if you guys see it go under 20, put these stocks in your watch list. It's a pretty good steal in my opinion. Basically, they own HelloSign. HelloSign is a competitor to DocuSign, and DocuSign has an enormous market cap, right? You guys know DocuSign. If you don't know, it's one of the biggest digital signatures out there where they process these type of signatures. And then lastly, we have Activision, which makes like all these type of gaming companies. They own Call of Duty. They have massive growth ahead of it. If Activision goes under 80, it's a buy in my opinion. 75 is even better. So that is that. If you haven't already, make sure to subscribe to this channel, and I'll see you on my next video.